Have you read Finance Bill 2025? By the way, the National Assembly Finance and Planning Committee set May 27th, 5 p.m. as the sunset date and time for you to submit your comments. What's significant about this bill? It was much anticipated because it came on the back of Finance Bill 24, which triggered so much public uproar and ended up being rescinded by the government. The first stark difference between Finance Bill 24 and Finance Bill 25 is just how much was targeted in additional revenue. Finance Bill 24 targeted a staggering 343 billion shillings. Finance Bill 25, we are told by National Treasury, targets just about 35 billion shillings. So if you compare like for like, it's about just 10% what was targeted last year. And that tells you it has a lot leaner proposals than what we saw last year. But what's significant this year? Compared to last year, there was an effort to try and clean up the Value Added Tax Act in terms of products which are exempted and zero rated. In fact, one of the reasons why Kenyans actually went to the streets was because of the proposal to expunge ordinary bread, which you and I buy every morning, from zero-rated status to standard-rated status, effectively subjecting it to 16% value-added tax. If you look at Finance Bill 25, it actually has a radical cleanup of the second schedule of VAT Act, which deals with zero-rated products. However, it doesn't touch on the aspect of bread, but you'll see there animal feeds, pharmaceuticals, etc. What does this mean? We are likely to see the net effect of the additional cost being passed on to you and I as end consumers. Another thing which you need to think about when you look at Finance Bill 24 versus Finance Bill 25 is that whereas Finance Bill 24 sought to raise revenues through introduction of new taxes like motor vehicle tax and a few others, Finance Bill 25 is leaning more towards administrative cleanups. If you look at the Tax Procedures Act, for instance, the government has very interesting proposals there. It's proposing to increase the window within which the Kenya Revenue Authority is given leeway to evaluate and ascertain a tax refund from the current 90 days to 120 days. Now, whereas this makes sense for the government in the sense that KRA will have more time to do this, for businesses who are waiting for those refunds, you are likely to be hit from a cash flow standpoint, and this could impact your working capital. One similarity between Finance Bill 24 and 25 is the issue of the use of data for tax compliance purposes. So whereas in Finance Bill 24, we saw a proposal to exclude KRA from the constraints of the Data Protection Act of 2019 for tax compliance purposes, we don't have that exactly as it was in this year's bill. What we have in its stead is a proposition to widen the purview of KRA to be able to access data on trade secrets and personal data for tax compliance purposes. Same thing, different words, and that's why there's so much talk about what does this mean from a data protection standpoint. Another stark difference we are seeing between Finance Bill 24 and 25 is the issue of effective dates. So in Finance Bill 24, and for many other finance bills we've seen in the past, we have July 1st effective dates for some measures, then September 1st, then January 1st the next year. If you look at Finance Bill 25, there is only July 1st, 2025 and January 1st, 2026, which only has two provisions, by the way. So what does this mean? It simply tells you the government, unlike in the past, is very keen to get as much revenue as possible, as fast as possible. And that is why the bulk of the proposals will be effective July 1st, 2025, depending in which shape or form Finance Act 25 will be looking like. Another thing which is a similarity between Finance Bill 24 and 25 is just the effort around disposable income. We have seen now in Finance Bill 25, there's a proposal to increase the tax-free per diem in the private sector from the current 2,000 shillings to 10,000 shillings. Now that is something which is designed to ensure that you have more money in your pocket. Another one is the inclusion of gratuity to be income tax exempt. If you go back to Finance Bill 24, what we saw there was the final pension payout was made income tax exempt. So basically this is just a continuation of what we saw in the last finance bill.